Welcome back to the SOXL challenge, everyone. It is a special episode today. If you have been following our monthly updates, you know that SOXL has been on an absolutely wild ride in 2026, from crashing 45% multiple times to hitting brand new all-time highs above $300. But today, I want to step back from the monthly portfolio numbers and tackle a much bigger question. One that could fundamentally change how we think about investing in this sector for the next decade. The question is this: is artificial intelligence actually changing the semiconductor business cycle? For over 50 years, semiconductors have moved through predictable boom and bust cycles roughly every 2 to 4 years. But now we hear constantly that this time is different because of AI. Is that true? Or is it just another version of the same old story that every hyped-up sector tells itself right before the crash? Let's dig into the actual data and find out. Before we can evaluate whether something has changed, we need to understand what the traditional cycle actually looks like and why it exists in the first place. The classic semiconductor cycle works like this. Demand for chips increases, often driven by a new technology trend like personal computers, smartphones, or cloud computing. Chip makers respond by building new factories and expanding production capacity. But building a semiconductor fabrication plant, commonly called a fab, takes 2 to 4 years and costs billions of dollars. By the time all that new capacity comes online, demand has often already peaked or even declined. This creates a supply glut. Prices crash. Companies cut production, delay new fab construction, and sometimes go bankrupt. Eventually, supply shrinks enough that the next demand wave causes a shortage again, and the cycle repeats. This pattern has repeated with remarkable consistency. The dot-com bust of 2001, the 2008 financial crisis, the 2011 European debt crisis pullback, the 2015 to 2016 memory chip downturn, and the 2022 to 2023 correction after the pandemic buying boom. Each one followed the same basic playbook: overbuild capacity, crash, digest the excess, recover, repeat. This is exactly why SOXL has shown us those dramatic multi-year cycles we have documented extensively in our monthly updates. The major dips at 33 cents in 2011, 99 cents in 2016, $3.57 in 2020, $6.21 in 2022, and $7.23 in 2025 are not random. They are the direct market reflection of this capacity overbuild and correction cycle playing out again and again. Now let's examine the argument that AI genuinely changes this equation. There are two distinct mechanisms worth separating here. The first mechanism is demand side. AI is creating what many analysts call a structurally larger and more durable demand floor. Unlike previous technology cycles that were driven by consumer purchases like PCs or smartphones, which are inherently cyclical because people do not need to upgrade every year, AI infrastructure spending is being driven by a small number of massive companies with enormous capital budgets. Microsoft, Google, Amazon, and Meta, often called hyperscalers, are spending tens of billions of dollars per quarter specifically on AI computing infrastructure. This spending is not tied to consumer replacement cycles. It is tied to a competitive race for AI capability that shows no signs of slowing. Second, there is a supply-side mechanism. AI is actually being used within the semiconductor industry itself to improve chip design efficiency, manufacturing yield rates, and supply chain forecasting. Companies like TSMC and Applied Materials are using machine learning models to predict demand more accurately and optimize their capital expenditure timing. In theory, better forecasting should reduce the classic overbuild problem that caused previous crashes. Combining these two factors, the bull case argument goes like this: demand is structurally higher and more durable than in previous cycles, while supply-side decision-making is more precise. Therefore, the amplitude of future cycles should shrink even if they do not disappear completely. Now let's look at the other side of this argument, because this is where things get genuinely interesting and where I think many optimistic YouTube channels stop their analysis prematurely. Morningstar, one of the most respected independent research firms in the industry, has explicitly stated that semiconductors remain a cyclical industry and that AI does not eliminate the boom-bust pattern, even while acknowledging that AI-driven demand growth is real and substantial. PIMCO, a major global fixed-income firm with deep expertise in industrial cycles, makes a similar point. Their analysts suggest the semiconductor sector may become less volatile than during the pure consumer electronics era, but they are careful to clarify that less volatile is fundamentally different from cycle-free. Here is a critical piece of evidence worth examining closely. Even within this current AI-driven supercycle we have documented on this channel, SOXL has still experienced 3 separate 45% or greater drawdowns within a single calendar year in 2026 alone. If AI had truly eliminated cyclicality, we would not expect to see this magnitude of volatility. The fact that we saw a 46% crash in March, a 45% crash in June, and another 45% crash in July, all within the same supercycle, tells us something important. The underlying mechanism causing sharp corrections has not disappeared. It has simply been layered on top of a stronger overall uptrend. There is also a very real concern about capital expenditure overbuild happening right now, just with a different name. Some analysts have begun questioning whether hyperscaler AI spending itself could eventually become the source of the next overbuild problem. If Microsoft, Google, Amazon, and Meta are all racing to build data centers based on projected AI demand that does not fully materialize at the pace expected, we could see a version of the exact same overcapacity problem that has caused every previous semiconductor downturn, just triggered by a different type of buyer. Let's get specific with some real data points rather than just theoretical arguments. Global semiconductor industry revenue has historically shown clear cyclical patterns with peak-to-trough swings often exceeding 20 to 30% in a single downturn. The 2022 to 2023 downturn saw global chip sales decline by approximately 8 to 10% year-over-year, driven primarily by memory chip oversupply following the pandemic buying surge. However, looking at recent capital expenditure data from the major equipment makers tells a genuinely interesting story. TSMC has continued raising its capital expenditure guidance multiple times throughout 2025 and 2026, reflecting sustained confidence in AI-driven demand rather than the typical pattern of capex cuts we would expect to see during a normal digestion period. Applied Materials and ASML have both reported that their order backlogs for advanced chip manufacturing equipment remain robust, with lead times for certain equipment stretching well beyond a year in some cases. This does suggest genuinely different supply-demand dynamics compared to previous cycles, where equipment backlogs would typically shrink rapidly once a downturn began. At the same time, memory chip pricing, which has historically been the most volatile and cyclical subsector within semiconductors, continues to show significant price swings based on inventory levels at companies like Samsung, SK Hynix, and Micron. This particular subsector appears far less insulated from traditional cyclicality compared to the leading-edge logic chip manufacturers who benefit most directly from AI compute demand. Based on all of this evidence, I think the most accurate framework is neither the purely bullish "this time is completely different" narrative, nor the purely bearish "nothing has changed at all" narrative. The reality sits somewhere in between, and understanding exactly where matters enormously for how we invest. I would describe this as a shift from a classic consumer electronics cycle toward what some analysts call a secular growth plus cycle model. In practical terms, this means the overall long-term growth trajectory for the sector may be higher and more sustained than in previous decades, because AI, cloud computing, automotive semiconductors, industrial automation, and edge computing are all expanding the total addressable market simultaneously. However, individual subsectors within semiconductors can still swing sharply based on inventory levels, capital expenditure timing, and supply additions. This creates what I think is the single most important insight from this entire analysis. The critical question is not will there be no cycle at all. The critical question is which specific parts of the semiconductor industry are most exposed to traditional cyclicality, and which parts benefit most directly from this structural AI demand layer. Leading-edge foundries like TSMC, and companies providing high-bandwidth memory specifically for AI applications, appear to be experiencing tighter and more durable demand conditions than in previous cycles. Meanwhile, more commodity-like categories, including standard memory chips and older generation logic chips used in consumer electronics, still appear vulnerable to the traditional overbuild and correction pattern we have seen repeatedly over the past 50 years. So how does this analysis actually change how we approach the SOXL surge strategy going forward? First, I think we should expect the possibility of longer upcycles than we have seen historically. If the demand floor genuinely is more durable due to AI infrastructure spending, individual bull runs like our current one that started at $7.23 in April 2025 could potentially extend longer than the historical average of 1 year 9 months to 3 years 11 months we have documented in our previous SOXL surge strategy video. Second, we should expect less uniform cyclicality across different subsectors. This means SOXX as a whole index may show more resilience during pullbacks compared to individual commodity memory chip stocks within that same index. Third, and this is critically important, we should absolutely still expect occasional drawdowns that are very real and very painful. The 3 separate 45% crashes we experienced in 2026 alone prove conclusively that AI has not eliminated volatility. It has simply occurred within the context of a much stronger overall uptrend. This actually validates rather than changes our existing SOXL surge strategy approach. We continue using EDCA, buying more aggressively during these drawdowns rather than panic selling. We continue avoiding margin entirely, since even a supposedly more durable cycle can still produce 45% single-week crashes that would trigger margin calls. And we continue maintaining our long-term 30-year investment horizon, because even if this particular cycle does extend longer than historical precedent, we should still expect meaningful pullbacks along the way that require patience and discipline to survive. So, is AI really changing the semiconductor cycle? Based on the actual data and expert analysis we have walked through today, my answer is yes, but not in the way most bullish YouTube content suggests. AI is not eliminating cyclicality. It is not creating a permanently smooth upward line with no volatility. What AI appears to be doing is creating a stronger underlying demand floor for specific parts of the semiconductor industry, particularly leading-edge chip manufacturing and AI-specific memory products, while the traditional overbuild and correction dynamics continue to play out, especially in more commodity-oriented subsectors. For those of us investing in SOXL for the long term, this analysis actually reinforces rather than undermines our existing strategy. We should expect this current cycle to potentially be longer and larger than historical precedent suggests, while still preparing mentally and financially for the inevitable sharp pullbacks along the way. As always, this analysis reflects my own research and personal opinion. This is not financial advice, and semiconductor investing, particularly through a triple leverage product like SOXL, carries substantial risk that may not be suitable for every investor. If this deeper dive into the data helped clarify your own thinking about the semiconductor cycle, please smash that like button, subscribe to the channel, and let me know in the comments which side of this debate you land on. Do you think AI has fundamentally changed semiconductor cycles, or do you think we are simply in the calm before another major storm? I read every comment and I would love to hear your perspective on this. Thank you for watching, stay disciplined, keep learning, and I will see you in our next regular SOXL challenge update. Peace out, SOXL family.